valid area. On the contrary, in other situations, the first red candle may provide a clearer and more reliable supply zone, depending on how the move develops and how price reacts afterward. Another important concept is the wick. Here, the demand zone is drawn from the wick of the candle, since it shows where price was rejected and the momentum move began. The move did not start from the first green candle, nor the previous red candle. It started at the bottom of the wick, which forms our demand zone. Wicks are important price action signals on the chart because they highlight areas where strong price rejection occurred. By marking these levels, we can often expect price to react again when it revisits the zone. With all that being said, here's a very important point. No matter how accurately you draw the supply and demand zone, getting rejected exactly from that zone is not guaranteed. Sometimes the market reverses before reaching the demand area, and other times it needs a deeper retracement. So, how do we avoid missing trades and stop-loss hunts? To reduce the chance of missing trades, you can place your entry a spread size above the start of the demand zone. This way, price can trigger your buy limit, even if it only taps the tip of the demand zone before rejecting. To avoid stop-loss hunts, you can give your stop a bit more room when dealing with a small demand zone. In the case of a larger demand zone, consider entering near the middle of the zone and placing your stop-loss below it. Up to this point in the video, we've talked about what supply and demand zones are, the psychology behind them, and how to correctly mark them on the chart. And now we're finally moving into the important part, how to actually trade them.